Hey guys, this is Bruce Marshall from Simpler Trading, and we're going to continue our topic of hedging and why we should hedge our portfolios and how to do it in some different varieties. I'm going to show you a different technique today in this video. Now, this is the fourth video in a mini series that I put together on hedging and evaluating the overall market in your portfolio. The first one we talked about the S&P 500, which I've got on the screen here, and why we want to use the S&P 500, generally speaking, as our hedging mechanism, because it represents the broad overall market. And the S&P 500 is always being rebalanced once a quarter, etc. So it's a good tool to use for us to balance a portfolio out and help us to make that more cost effective. Now there's three ways we can do it. There's more than three, but the main three ways: we're going to talk about the SPX, we're going to talk about the SPY, which is 1/10 of the SPX, and then we're going to talk about today primarily XSP, which is also 1/10 of the S&P 500. So this is the grandfather here, and these are the others that follow behind it, the smaller versions of these. These are very, very useful, and I'm going to show you why. Quick recap: the first video I did was on the S&P, why we want to use it, how to evaluate it, how to tell what you need to properly hedge a portfolio. It depends on a lot of variables, right? That's why I ended up making four different short videos, so we can cover all these in depth. The second one was on SPY and some institutional hedging, and we went and found some institutional trades, hundreds of thousands of contracts. Check out that video. That's number 2 video on SPY, and a way that we can piggyback on these institutional trades. We do it all the time in my bias trade room. So the third video, we went back to SPX and we did how to get the most bang for your buck out of kind of shorter term trading. The SPY was more black swanish kind of thing. That's a good little video. You should watch that one if you get a chance. The SPX was kind of general hedging on a little bit shorter term maybe, and how to really get a lot of bang for the buck out of it. Now this one we're going to jump into XSP, and we're going to do the same thing. So very quickly, the SPX, if you are familiar with this, you'll know what I mean. The SPX and the XSP, these two are what's called European style options. That means they cannot be exercised early. Though you can hold them to the very end, nothing will happen. SPY is American style, and it can be exercised a little early. Just be aware of that. And let me know in the comments if you want me to do a more detailed video on that. I'm certainly happy to do that. It's not a problem. But let's jump into XSP. Let me switch this chart over, and we will take a look. So here is XSP. I always get that mixed up. So you got SPX and XSP. Again, this is the mini SPX options, not futures. This is options, right? And as we can see here, we've been looking at this chart. Now I'm filming this, recording this on May the 2nd. A lot of craziness going on. Geopolitical stuff is going on. We've got Fed meeting coming up also this month. We've been chopping here for a little while, and this kind of range bound chop. We don't know if we're going to go higher, we're going to go lower. I think there's maybe a little bit better chance we go lower. I don't know. It's very, very tough to say, but that's why we want to have some hedging. And I would call this kind of hedging light, L-I-T-E, because we're going to get a lot of bang for the buck out of this type hedging. So let's jump right in. All right, XSP. First, we determined that we want to use XSP. Maybe we've got other trades in SPX, or we don't want to spend that much, or maybe you don't need that much hedging. Say you've got a lot of cash or you've got a lot of bonds. This is a good way to do it. They're in $1 increments. These options are. It's very flexible. So the first thing we need to do is to kind of figure out how much protection we need. The second thing to do is to figure out where our target might be. And just to keep it simple, and I actually did this in the last video, I said let's just target this is the 200-day moving average, simple moving average. Very simple. I like to keep my charts simple. There's that blue one is a 20-day moving average. This is a 50-day moving average. This, or I should say period moving average. This is a 200 period moving average, or in this case daily moving average. So what if we were to come down to there? Well, that would make sense, wouldn't it? I mean, it's reasonable, it's feasible, right? if we go back and look, you see this low here and this low here, they correspond with the 200-day moving average right there. I think that is a very possible place that if we do come back, that's where we could go to. Okay, we're just starting here, right? We're going to throw a very wide net in case we're wrong, in case we overshoot it, that type thing. So how long do we think it might take us to get there? And again, I'm recording this on May the 2nd, and let's say it takes a couple of weeks. I'm not talking about Black Swan going out to October, that kind of thing. I'm talking about short term, short and sweet, very simple kind of stuff that we can all do right now, right? So 1 week's not really going to help us much. 2 weeks, let's go out 3 weeks, maybe 4 weeks. Let's go to the end. Let's go to March. I don't know. Let's go to the 27th. This protects us for a month, right? So we go to our trade tab over here. Now I'm using Thinkorswim. This is Charles Schwab Thinkorswim, right? And I've already got it pulled up here. So XSP, the mini SPX, right? I'm going to go to 27. Remember, 27 March, right there, 27 March. That's 25 days from now at the time of this recording. And remember from our chart over here, we think that it's possible that we pull back here to that red line, which is the 200-day moving average, which is at 656. So remember, XSP is 1/10 of the SPX. So SPX would equal, XSP is 656. SPX would be 6560, right? 1/10. This is 1/10. Makes it easy. All right, so let's get over here, and we're going to target 656. Let's do a round number. Let's do 655. That makes it easier. All right, so let's go. We're going to need more strikes up here. Let's go 655 right there. 655. Again, I'm getting that from that number right there. We're going to round it down a little bit, and I'll show you why in just a second. So let's just say right now, and we'll do it right here, the closing price, and my drawing tools are on this monitor here if you're wondering why I'm looking over here. All right, 688, that's our current price, right? We're going to target here. But first I want to show you what you can do. If you just don't know, you don't have any idea, you just want some protection, immediate protection on the downside, right? And then we'll come back to the 655, but the easy way to do it, we're trading at 688. Let's go to 688, and we're going to buy a simple vertical. Super simple. Now toss will default to the next strike down, so it's 688. Excuse me, 687. So let me show you what that looks like. We can go over here to our trusty Analyze tab and excuse me, disregard all these other things I've got up here. That's just some other stuff I was working on. But as you can see, excuse me, this vertical costs 33 cents. Okay, 33 cents. Pretty cheap, right? Now this is for $1 widespread. So the way to read this, you see this over here, 328, that's when it expires. The option expires on 327 and actually closes out the next day on 328. But in this case, 10 contracts, right, times 33 cents is $330 of cost to the upside, and we make 670 on the downside. You see that right there? And if I hover over here and you watch here, it's $330 of cost. Pretty simple math, right? It's about 2 to 1, a little bit better than 2 to 1. That's pretty neat, right? And it just doesn't take anything to throw that on, and now you're covered. Again, I know that that's not much, but the point is here how to set it up. I'm going to show you how we can size it up a little bit bigger. So let's say that we want more bang for the buck from that. $600 is not going to help us much. So let's go 688. I'm going to drop this down and go to 683. So now we're 5 points wide. Look at our cost. When we widen out this spread, it's going to increase our cost. So we go from 33 cents to $1.58. So now we're going to risk over here, we're going to risk $1,580 for 10 contracts, and we'll make $3,400, about 2 to 1, kind of roughly, right? So there's a method to the madness here I'm going to show you. So let's say, let's widen it out a little bit more. And I'm actually going to move this for round numbers. Let's move this up. Well, I'll tell you what, we'll keep going down in the same pattern for now. I'm going to move the 688 down to 685 and then move this down to 680. So now we're 5 points wide. We moved it down just a little bit. It's $1.40, 1400 to make 3500. Pretty nice. You can throw this on in 45 seconds and at least you're covered. Now, I will say this. Let's look at the chart real quick. Let's go to, say, a 20-day chart. What you ideally want to do is to come in here on these highs and enter the trade here. You don't really want to enter it after you've already sold off so far, unless you think the market is going to keep going, right? So ideally, and when I like to do this is when we're hitting a new all-time high, for example. Put some of these on maybe 2-3 weeks out. Gives you a little bit of light hedging. You know, I told you we were going to talk about light hedging. Let's take it a little bit further. Say, you know, this is not going to help you much because you're trading a larger account. And again, in this example, why we're using XSP, maybe we've got a lot of bonds, maybe we've got a lot of cash. We don't need that much, or maybe we're trading a smaller account. Now, been working with people. I've been trading professionally for 35 years, and I work with people with professional people that are typically retired or retiring, large portfolios, that type thing. But we still have plenty of use for this because we can use this on an ongoing basis. For example, we use one for 3 weeks from now, and maybe we go out 6 weeks and use another one, and then 8 weeks and use another, that type thing. Kind of ladder those on. But if we spread these out even more, let's go 685 and we'll drop down to, say, let's go 665. Okay, we're widening this thing out. Now it's getting more expensive here, right? $4.62. Okay, now so we've got $4,600 of risk. That is if we just rip higher and go higher. On the downside, we're going to make $15,000, and we don't have to go very far to go to our max profit. And you might say, well, that's still not that much. Okay, well, very, very liquid here. Let's do 50 contracts. Okay, that's 23,000 at risk to make 77,000. You're trading a $250,000 account, risk 23,000. Maybe that's a little much, but you know, you got $77,000 of downside protection there in the event something is going to happen. And this might be around a Fed meeting or just general jitteriness of the market or whatever, geopolitical stuff like we're having right now, etc. Size this up and down. If you want to get even more bang for the buck, let's look over here and say, let's go back to XSP and go, what is our expected move? I covered this in one of the other videos. Our expected move in this instance is 30 points, right? So if we're at 688 and we've got a 30-point expected move, that gets us to 658, right? 30 points. Now, I see a plus and minus. It could be up or it could be down, but let's go to the downside here. So that gets us to 658. Let's just say 660 for a round number, right? So let's go to 660 and we're going to just buy a vertical. A vertical is the same thing as a put debit spread, same thing, right? All right, so now is where it gets a little more interesting. In this case, if we thought, you know, just based on our expected move here, and we'll look, that gets us down at 660, gets us down, sorry, where are we? Okay, yeah, 660. All right, the first one we were putting right at the money right here, right? We're going to move down to our target, which is 655, which coincidentally, remember this, 30-point expected move coincidentally lines up with 655 right here, right? So that would be our ultimate target that we think we might get down to. So in this case, it's 17 cents. So $170 turns into $8.30, right? That's pretty cool. Now that's only 1 point wide, so I'm going to widen this thing out a little bit. It'll get more expensive, but it'll give us more bang for the buck. 655. Now this costs 72 cents. All right, for $720, if we get down there, you can make $4,200. Now we're talking. Now we're making some money. Let's do 50 contracts. $3,600 gets you 21,000. Pretty good, right? Again, we could widen this out. We go to 650 660 to 650, buck 30. So now we're risking $6,500 to make 43,000. You get the point. You can play with these numbers. You can widen out the spreads this way. You can put them right at the money here, or you can go down to our target or your target, whatever. Again, in this case, you know, the original target we came up with was this 200-day moving average, or you could just simply go over here and go, I'm going to put it about where that expected move on the downside should be. That's basic stuff right there, right? But again, this gives you an idea. Again, if you're trading a, let's say a $250,000 portfolio and you spend $6,500 to hedge on an event that you think's coming up in the next several 2-3 weeks, you know, 43,500 bucks, if you're right, is pretty good. Now, again, hedging is, you know, it's, I was going to say it's never free. Sometimes it is. You can do a little more advanced things, and it's, you can pay for this trade with other ways, selling premium around it, etc. But if this thing just rips higher, you know, you're out this money, and you can always pull the plug. It doesn't go from, you know, 6,000 to zero. If, you know, if it starts going up and this goes, you might say, I want a 50% stop loss. This thing starts ripping up, the market's ripping higher, and your hedge is now worth 3,000. You say, you know what, that's not going to work. I'm going to go ahead and, you know, take my loss and move on. A lot of ways to manage this. I can help you do this. We do this all the time. We set these up in my trade room. But I wanted to talk about this XSP because, again, we've got SPX, we've got SPY, XSP. These cannot be assigned early. Big thing if you're going to hold this to the end in a hedging scenario. So be aware of that, right? Very useful, very flexible tool here. So I'll give you a real quick example. If you're a little more advanced and you say, you know, here's $6,000 here to make 43,000, and you look at the chart and you say, you know, the lowest I think will go is, I don't think we'll go lower than, I don't know, say 630. I'm just picking a number here. Let's see. Well, we'll go down even further than that. Let's go 600. And if you come down here, now this is a little more advanced. I do these a lot. I want to know how to pay for this thing, right? So we'll go 600, and we go 590. And we don't need 50. Let's do 20. Okay. Well, that didn't help us. That's not enough to pay for it. Let's see. Let me move this up. But you get the point here. Let's do, that's 52 cents. Okay, well, you reduce your cost there a little bit. We'll move it back up here. I didn't fix that ahead of time, but this is a really good example because this is kind of how it works. So in this example, you know what? Let's see. Yeah, this will still work. All right, let's do 25 contracts. Okay, so we lowered our cost based on the upside from 6,700 to 4,200. If you see over here, 4,200, and now our profit went up to, we cut about $2,000 off the cost, and we added this into the profits. What I'm trying to do. You could also get a little even more creative and sell something on the upside if you're bearish, and bring in more money and reduce this risk even more. That's a little more advanced. You don't have to worry about that. But this is the general concept here that I wanted to cover. So let me know if you have any questions on this. Again, this is the 4th video in a 4-part series, a little mini series on hedging. I'm trying to keep it short, but anyway, hope that helps. Join me in the my bias trading room here. I'll put a link down to our trading room. We do these all the time. More than happy to help you answer all your questions and all that. Again, if you want to do this real time with me, and we do all other type trades as well, but this is just in some examples of trying to put together on hedging. So hope it helps, hope it makes sense. Let me know if it doesn't in the comments, or you can reach out to me at Simpler Trading. And again, I'll put a link down below. So thanks for your time, guys. I appreciate it, and I will see you at the next video. Thanks.